Welcome to the deep dive. Today, we're cutting through the noise on what was, I think, one of the most volatile post-earnings moves of the entire quarter.
Oh, absolutely.
We are going deep into Nike's Q2 fiscal 2026 earnings call. It dropped after the market closed on December 18th.
And if you were watching the tickers, you just saw chaos, instant chaos.
Yeah.
This was the absolute epitome of a beat it down quarter.
Explain that. What does that mean?
It means the headline numbers looked fine, good enough to satisfy the analysts, but the details, the strategic pain points management revealed, led to a brutal market reaction.
How brutal?
We saw the stock indicating downside prints of up to 10.76% after hours.
Wow. And that's a huge move, especially when you think about what the market was expecting before the call, right?
Exactly. The implied volatility from the options market was only pricing in about a 7% swing. So the market was braced for a move, sure, but not this kind of aggressive downward conviction.
So really, the mission for this deep dive is to figure out why. Why did the market punish a company for what looked like a successful revenue quarter so severely?
You have to start with the positives because, they were there. They did manage to navigate a really tough consumer environment.
Okay.
GAAP diluted EPS came in at a pretty robust 53 cents. That easily beat the consensus estimate of 37 cents.
So a big beat on earnings per share. What about the top line?
Revenue also held up, came in at $12.3 billion against a consensus of around $12.21 billion. So that's 1% reported growth year over year.
Okay, so let me get this straight. They made more money than expected, they made more per share than anyone expected, and yet the stock still cratered 10%.
That's the paradox.
And the answer has to be in the quality of that revenue and what it did to their profitability.
That's exactly it. This is where the structural pain just became obvious. The gross margin, it plunged to 40.6%.
Oof. And for anyone who's a sophisticated investor listening, that 40.6% figure is alarming.
It's deeply alarming. It was down a full 300 basis points from last year.
Okay.
Historically, the street sees anything below 42% as a real concern. Dropping into the low 40s like this, it suggests one of two things. Either your pricing power has eroded, or you're doing an extremely costly internal cleanup.
And that, of course, hammered net income.
Oh, it fell hard. Down 32% year over year to just $0.8 billion.
And that margin compression, it came directly from that unfavorable mix you mentioned. Let's break that down for everyone listening, because it really is the core of the whole problem.
Right.
Wholesale was actually the star of the show, $7.5 billion, up 8%. That proves they are fixing those crucial partner relationships.
And this is the big but, that wholesale strength came directly at the expense of the premium high margin side of the business. The Nike Direct segment, which is all their sales directly to you, the consumer, that dropped 8% to $4.6 billion. And the most crucial slice of that, the highest margin part, Nike Brand Digital, it declined a massive 14%.
So you're basically swapping sales from your highest profit channel, digital, for sales in your lowest profit channel, wholesale.
Right.
It's, I guess, a necessary trade-off to clean up the market, but it makes even a top-line beat look like a major profit warning.
It absolutely is a profit warning. Now, before we get into the strategy, I do want to acknowledge one bright spot.
Okay.
The balance sheet is healthier. Inventory was down 3% year over year to $7.7 billion. This confirms that the painful cleanup they've been doing, cutting inventory, reducing supply, it is starting to work. It's setting the stage for better long-term health, even if it really hurts the margins right now.
Okay, so let's unpack how management is talking about this. CEO Elliott Hill, he spent a lot of time framing the situation. And the line they used was that the turnaround is only in the middle innings of their Win Now plan. For you listening, this is a multi-year plan with 4 main goals. Recenter on sport, rebuild wholesale, rebalance the product portfolio, and really step up marketing.
And the most compelling proof that this strategy can work is what's happening right now in North America.
Right.
This is the operational playbook they're trying to export everywhere else. And here, it is just firing on all cylinders. North America revenue grew a powerful 9% in Q2.
And if you dig into that 9%, the wholesale channel just exploded. It spiked 24%.
24.
Now, some of that was just restocking, but management was very clear that it was a strong, balanced contribution from both new and old partners. It really confirms that their focus on repairing those relationships is working and mail even better than expected in their biggest market.
And that success It's rooted in what they call the sport offense. The commitment to performance running is, it's undeniable. We saw the running business grow over 20%.
For second quarter in a row.
For the second consecutive quarter. That kind of performance, it really suggests they are taking market share from competitors. And it's not just running. They're seeing momentum build in basketball and training too. It reinforces this idea that the brand is truly getting back to its performance roots.
And this is where we have to connect that operational success back to the long-term margin story. This whole shift, it requires cutting-edge innovation. You have to have it to justify premium prices and escape that trap of just becoming a lifestyle brand that competes on price.
Precisely. Innovation is the shield against margin erosion. They even cited a few specific examples that show a more diversified product focus, not just, another running shoe.
They mentioned the Structure Plus, which is a key update to their stability running line. That followed the success of the Structure 26, so it proves they can refresh those older heritage lines with new tech.
But the real insight for me was when they talked about moving beyond just updating shoes. They debuted the new Nike Mind footwear platform for training. They described it as a completely new dimension for their training offense.
And for apparel.
For apparel innovation, they highlighted the Thermopit Air Milano jacket. It's a high-tech piece from their ACG line that actually uses an inflation system for dynamic warmth.
That Thermopit jacket is a perfect example of what they need to fix the China problem. It's premium, it's high-tech, it cannot be easily copied or sold at a discount. It supports that whole narrative of shifting back to an innovation-led strategy that justifies higher prices.
Which in turn supports margin recovery. And this forward momentum, you can see it globally. A key future indicator they dropped was the order book for Nike football products.
What'd they say about it?
It's nearly 40% higher than it was before the 2022 World Cup.
Wow.
So their wholesale partners are showing confidence. They're buying big into the new product story for the second half of the fiscal year. The execution is there. The problem is that it is being completely overshadowed by two massive structural headwinds.
The first, and I'd argue the most painful one for the stock, is the China conundrum.
China was an absolute anchor. It was the clearest drag on the entire quarter. Sales there declined a steep 17% year over year.
And that flows right to the bottom line.
A 49% decline in EBIT for the region. The diagnosis from management was pretty stark. The brand had, in their words, morphed into a lifestyle brand competing on price instead of maintaining its premium innovation-led position.
It's a really tough reality check for them to admit, and the pain is obvious in the digital numbers too. Nike Digital in China fell, 36%?
36%.
Yeah.
All because of plummeting traffic and just weak sell-through. So to fix this, they're taking these deliberate, painful actions that are just crushing revenue in the short term.
What are they doing specifically?
They detailed two surgical actions. First, accelerating the return of old partner inventory, so basically paying to clear the shelves. And second, severely cutting back on digital promotions. They said that during the huge 11/11 sales event, they were way less promotional, which led to a voluntary 35% drop in sales during that key period. These are necessary resets, but man, they guarantee short-term pain.
And the second major headwind is the one that's totally external and hits the margin line directly. Tariffs. We already know gross margin plunged 300 basis points, and a huge chunk of that is geopolitics. It's completely outside of their operational control.
This is the $1.5 billion structural elephant in the room. Management highlighted a staggering $1.5 billion in annualized incremental product costs just due to higher U.S. tariffs.
That is just an almost insurmountable hurdle, isn't it?
It creates an enormous handicap. That $1.5 billion translates to a gross impact of about 320 basis points on the gross margin for the whole fiscal year.
So even if they executed perfectly on everything else, logistics, sourcing, mix, they're starting the year at 320 basis points in the hole just because of trade policy.
Exactly. Now, management did firmly reiterate their commitment. Margin expansion is still the top priority, and they see a clear, long-term path back to double-digit EBIT margins once this tariff issue is, stabilized or absorbed.
And that commitment is crucial context for the guidance, which is really what spooked the market.
Oh, yeah. The near-term pain is absolutely going to continue. For Q3, they're guiding revenue to be down low single digits.
And the Q3 gross margin guidance confirmed that softness, right? They're expecting it to be down, 175 to 25 basis points?
Correct. And that is the headline investors saw. Revenue shrinking, margins shrinking even further. That is why everyone hit the sell button so violently. They're pricing in a clear continuation of this profitability decline.
There's a really critical analytical takeaway here, a signal that a sophisticated investor has to pull out from all that noise.
Yes, there is. Management explicitly stated that excluding the 315 basis point impact of higher product costs from these new tariffs, Q3 gross margin expansion would actually be positive.
Wait, hold on. So if the structural geopolitical headwind is running at roughly 320 basis points, and they're saying that excluding a 315 basis point impact, they'd see positive margin expansion, are we talking about a 5 basis point difference between their internal recovery and the external cost?
That's exactly the point. It means the underlying recovery, the benefits from the Win Now plan, the marketplace cleanup, the mix shift in North America, it's already generating enough efficiency to nearly, but not quite, offset that massive external tariff drag.
That is the hidden signal.
That's the hidden signal of underlying health fighting against a powerful external headwind.
But the market chose to ignore that signal completely. It just focused on the headline Q3 margin drop and the total lack of clarity on when China will ever stabilize.
That's investor psychology right there. I mean, the athletic footwear market is super promotional, intensely competitive. You have challenger brands like On and Hoka with strong growth stories. And in China, you have powerful domestic players making that reset even harder. Investors just want certainty right now.
So what are the analysts saying?
It's pretty mixed. You have firms like Jefferies who see this drawdown as a buying opportunity. They're holding on to their buy rating. But the general sentiment is cautious. People want to see irrefutable proof that the China reset is working and that the margin repair is for real.
Okay, we've covered the numbers, the strategy, the two massive headwinds. So based on all this contradictory data, what's the path forward? This brings us to our segment. This is not financial advice. This is purely for idea generation for you, the listener. We're going aggressive here, pitching a tactical but plausible trade idea based on the extreme market reaction we just saw.
Right. So the whole thesis here is that the market completely mispriced the internal execution strength. It overreacted to the Q3 guidance and the China drag while ignoring the strong North America execution, that 9% growth, and the recovering global wholesale order book.
A 10% sell-off prices and maximum pessimism.
Exactly. It ignores the fact that their operational cleanup is already offsetting nearly all of that tariff pressure.
So we see a mispricing of that core North America strength versus the temporary geopolitical drag. What's the specific move?
The idea is to go tactical long on the stock. You're betting that the successful North America playbook recentering on sport, driving innovation, can be exported to their AIMEA and APLA regions faster than the market currently expects. It's a bet on management's demonstrated ability to execute a turnaround.
And how do you neutralize some of the broader sector risk, given how promotional everything is?
You fund this long position by simultaneously shorting the discretionary retail sector ETF, the XLY. Or you could pair it against a high-flying competitor who might be nearing peak valuation.
That pairing is key.
It's crucial because Nike has lagged the market so much over the past year, down over 12%, while the SPY is up nearly 17%. This becomes a pure bet on execution risk being overly discounted, and you use the short to hedge against any broader macroeconomic shocks.
It's a compelling, aggressive pitch. It forces you to differentiate between that structural noise and the operational signal. I mean, this deep dive has really shown us a company stuck in a kind of operational limbo.
It really has.
You're balancing proven, severe short-term pain China, that huge $1.5 billion tariff headwind against demonstrated success in their core market, the strength in running, and a clear improvement in the forward order book.
So what's the ultimate judgment call for you, the learner? Management closed the call by comparing their turnaround to a championship team, focused on perseverance and sticking to the game plan.
Right.
This raises the essential question. Does the confirmed strength and innovation, from the Nike Mind platform to the Thermopit jacket and the operational success in North America, prove that the long-term potential is worth the current volatility? Or is the complexity of fixing China and mitigating that massive tariff impact just too big of an obstacle for the next fiscal year? That calculation of risk versus reward is now squarely in the hands of the market.